is maybe a bit expensive, we can still, on the basis of this, determine how much VAT was generated or consumed from one state to the other. There's also the complaint around exemption, because there are some states what they deal in are mostly exempted, the agrarian states mostly. And of course, what they don't know is the fact that there is a nominal VAT.
Okay, you are speaking to a particular section of the document which says that no VAT will be charged on food items, electricity, school fees, or medical services, ensuring prices stay low for the poor. Exactly.
So there are a long list of items that are now zero-rated. They used to be exempted, but they are now zero-rated. And there are also some that are still exempted, like rent, like transport, and all that. They are still exempt. So for all those that are zero-rated, what it means is that when you consume those items, VAT is not charged.
Yeah.
And so the person who is selling those items will not charge you VAT. And of course, if in the course of producing those items, they themselves have incurred or paid any VAT, they will be eligible for a refund of the VAT that they have paid. That is the implication of exemption. I mean, of zero rating as opposed to exemption. Okay, and the impact of that is that for a state like Benue, where mostly is food items, yes, you will wonder how would VAT be attributed to them. Okay, of course, that will be done on the system. Okay, there will be nominal attribution on the basis of how much activity, business, commercial activity that has taken place, as long as invoices are issued. Okay, so which means those who are below the threshold for VAT registration and filing, that is those with turnover of 50 million and below, will not be able to file those returns. But as long as you issue invoice, whether you have charged VAT or not, the system, the expectation is that there will be a nominal VAT that will be attributed so that it can be used as a basis for this derivation. It's a whole lot of provision. If you look at the provision in the tax bill, it says that the Federal Inland Revenue will issue a guideline as to how this will be done. And this is something that people will still have input into.
Okay, let's also speak to the progressive VAT increase. And of course, is here saying that VAT rate will rise gradually from 7.5% now to 15% by 2020. But basic necessities like food and medicine remain exempted. This is also generating controversy because Senator Ali Ndume did say that the federal government is trying to tax the poor the more. But it's not going to rise once. It will take a couple of years before the progressive VAT increase will get to 15%.
Correct. So what we presently have is such that the VAT looks like a sales tax because there are input VAT that you incur, you're unable to claim. If you are a manufacturer and you buy equipment, at the point of entry or the equipment, you pay VAT. And that VAT becomes part of your asset. You are unable to recover it. You're not supposed to be paying VAT because you are using the equipment to generate food, to generate a product that will be sold. So the new bill, says that when you incur input VAT, if you pay VAT on your asset, you are eligible to recover it. If you pay VAT on your overhead expenses and other items, you are eligible to recover it. If you pay VAT on your raw material, which is the normal one that has always been allowed, you are eligible to recover it. So that means that more deductions will be made from the output VAT. So if the rate remains 7.5% and you are having more deduction from what you are charging, at the end of the day, you are having zero to remit to government. All right? And that is why, for the purpose of ensuring that the reform is implemented, government is willing to say that you can take all those deductions, but let's have a marginal increase to 10%. That 10%, I can assure you that even what will go into the tax pool as far as output VAT is concerned will be reduced because you are now having more deduction. Okay? By the time yes. By the time you increase in 2026 to 12.5%, maybe a little bit more margin, or maybe government will be breaking even at that point, really, by 2026, when the rate is now 12.5% because of the deduction. And companies are going to be enjoying this benefit because what they are unable to deduct before, they are now able to deduct on their fixed assets and on their overhead expenses. But by 2030, when it is increased to maybe 15% by 2030, we will have understood the VAT proper, the way it is supposed to be, not what we have now. And then maybe at that point, we can now say that, yes, we are running a proper VAT system. And in order to reduce the impact, because of course, the headline rate increase will be taken seriously by the public. Okay? So in order to reduce the impact, most of the things being consumed by the general public, food, medical, education, all of those are now to be zero rated. So which means there will be no VAT on them. And from analysis, over 82% of what people generally use will be zero rated or exempted.
And that will bring their cost down.
Definitely. Okay, while the other, which people don't have choice but to do, like about 18%, the impact of that increase will be on that 18%. And so it's not going to be that significant on the general public. Okay, so mostly luxury items will be liable to.
I was going to ask you, I was going to tell you rather to correct me if I'm wrong. Yes. It does appear that the rich are afraid of this tax reform bill because they will end up paying more.
In all ramifications, either from their personal income tax, because the rate is now a bit enhanced, and it is expected that the high net worth individuals will have to pay a little bit more.
Which is what we have in other climes.
Yes, and then for the VAT, those who indulge in luxuries, items that they can avoid, will also have to pay the increase from 7.5 to 10, and then 10 to 12.5, and then
15 by 2030.
But of course, if you look at the West Africa and other countries, there's nowhere that the rate is less than 15%. So it's not like we're jumping, Nigeria is jumping out with a rate that is out of this world. Yes.
Okay, let's also speak to an aspect of the bill, precisely local revenue generation. There's something for local government here as well, because from what I have here, LGAs will be able to manage taxes, fines, and rates within their jurisdiction to boost efficiency.
Yes, so the implication is that all the nuisance taxes, most of them, will be harmonized.
Multiple taxation.
Yes, no, I mean, yes, we call it multiple taxation, but there are nuisance taxes. Taxes on television, radio, signboard, wheelbarrow, in fact, anything you do, they are running up and down after you, all right? And they are really not generating much. So the essence of this bill is to harmonize those nuisance taxes to very, very minimal few, which will still keep the soul of those who are in those local governments together. Meanwhile, they are getting enhanced share of what is coming from the center in terms of VAT, and that is why this derivation thing was being put forward. And of course, if a jump from 20% to 60% is considered high, why not 40%? Or why not 30%? Just to ensure that those who are dropping what they have perfected way of collecting on those nuisance taxes are not going to be out of pocket, and it will be enhanced by by this extra share from the derivation. Okay, so local governments, yes, they still have their revenue authority. We have local government revenue authority. We have state internal revenue service. They still have their work, but it will now be very limited, and that's what we mean by the harmonization of the nuisance taxes. Okay,
finally, before I let you go this morning, let's also speak to the streamlining of collection. I'm aware that the Nigerian Revenue Service will now take over tax collection from agencies like customs, enabling regulatory bodies to focus on oversight.
Correct. So the focus on that is to reduce the number of marks taxes being collected even now. For example, education tax is now going to be subsumed under the development levy of 4%, which used to be 3% of accessible profit. You have the Nigerian Police Trust Levy. Okay, that expired in 2023, but it used to be 0.005% of profit before tax. We have the Naseni tax of 0.25% of your profit, and we have the Information Technology Levy of 1% of profit. All of those will, over time, be subsumed. That does not mean that those agencies are not going to continue their work. The expectation is that where their law does not provide for appropriation, that should be amended so that government will appropriate directly. You cannot allow everybody to be collecting taxes for whatever they want to do. Okay, in terms of custom and others, it's just central accounting. It is not that you are saying now that FRS will start collecting custom duty on their behalf. It's the central accounting that is being, and it's not even clearly stated in the bill there. But we're pushing for those other marked taxes so that we can synchronize them under the 4% development levy, which at the end of the day will be mostly devoted for student loan.
All right, we must thank you very much, Albert Falonshaw, Managing Consultant, Preston Padebu, giving us insights on the new tax reform bill, which is before members of the National Assembly. And from his submission this morning, we can see that Mr. President is already thinking forward as to how to grow the economy of the country, as well as the revenue generation mechanism of the Federal Republic of Nigeria. We thank you very much for sharing your time with us on the program this morning.
It's my pleasure.
Okay, we'll be taking a very short break on the program. When we come back, Adebimpe is already standing by to take you through what the conversation that we are going to have on the Lagos end of the conversation this morning. Do stay with us.